Japan's land myth collapsed, and stock prices plummeted by 70%. Why did this unprecedented frenzy lead to 30 lost years of stagnation? The Nikkei 225 stock average fell below 20,000 yen in just 3 years from its all-time high of 38,915 yen, while real estate prices plummeted to 1/10 of their peak. Total losses amounted to an astonishing 1,500 trillion yen. In fact, this economic collapse had structural causes that continue to repeat even today. What exactly were these factors? Excessive credit, distorted monetary policy, and runaway collective psychology. In this video, you will learn why success became the seed of failure, what was overlooked and by whom, and what lessons we can draw for today's economy. Focus on these 3 key points. Now, let's delve into the full scope of that collapse. In the main feature, we'll also explain in detail the decision-making processes of the Bank of Japan and the government at the time. In the late 1980s, Japan was at the absolute peak of its economic prowess. The streets buzzed with energy, and everyone believed in a prosperous future. Land prices in Tokyo were said to exceed those of the entire state of New York, with even small plots trading at exorbitant rates. The myth that land prices would never fall was born. Stock prices, represented by the Nikkei 225, reached an unimaginable level of 38,915 yen. Companies, backed by abundant capital, continued their aggressive investments. Golf club memberships were bought and sold for hundreds of millions of yen, and renowned overseas paintings and real estate were acquired one after another. Japan's money was sweeping the globe. This was no ordinary boom. Everyone believed that this prosperity would last forever, and an overwhelming wave of optimism enveloped society. However, underlying this was a deep involvement of international currency coordination and domestic monetary policy. The first pitfall lurking behind success. The 1985 Plaza Accord. This agreement led to a stronger yen and weaker dollar, severely impacting Japan's export industries. In response, the Bank of Japan gradually lowered its official discount rate to stimulate the economy, introducing a record-low interest rate policy. Funds, with nowhere else to go, flowed into the real estate and stock markets through bank loans. This became the direct trigger for the bubble. Companies and individuals borrowed funds at low interest rates, investing in real estate and stocks. A dangerous cycle began where rising asset prices encouraged further borrowing. Banks, in turn, extended more loans based on real estate whose collateral value seemed to continuously rise. Everyone believed this was smart investing, without a shadow of doubt. However, this asset inflation began to diverge from the growth of the real economy. Corporate profits and individual incomes simply couldn't keep pace with the skyrocketing asset prices. It was, in a sense, like a balloon inflated with air. Despite carrying the risk of bursting at any moment, everyone enjoyed its expansion. The government and the Bank of Japan, witnessing this fervor firsthand, were unable to implement effective countermeasures. There were concerns about political pressure and excessive intervention in the economy. But here, a trap that no one noticed lay open. That prosperity, in reality, was merely illusory prosperity. At the end of 1989, the Bank of Japan began to gradually raise its official discount rate, a monetary tightening, but one that came too late to quell the bubble. Furthermore, in 1990, the Ministry of Finance introduced total volume regulation on real estate loans, instructing banks to curb the growth of their lending to the property sector. These policies slammed the brakes on a market that had become dependent on an excessive supply of funds. Why at this particular timing? Out of concern for the economy, the Bank of Japan kept postponing tightening, which ultimately allowed the bubble to inflate even further. Moreover, a strong belief in the land myth had taken root among the public. Everyone clung to the illusion that assets would eventually rise again. Economically, this is known as the sunk cost fallacy, a psychological state where one becomes fixated on already invested costs, rendering rational judgment impossible. The trap of groupthink was also severe. In a situation where everyone around them was making profits, a conformist pressure emerged. I don't want to be the only one losing out. Financial institutions, even knowing that excessive loans were beginning to turn into non-performing assets, couldn't tighten immediately. They feared criticism for loan stripping. Ultimately, due to delayed policies, collective psychology, and an obsession with short-term gains, the bubble careened into an unstoppable runaway spree. In August 1990, Iraq invaded Kuwait, igniting the Gulf War. Crude oil prices soared, spreading anxiety throughout the global economy. This was compounded by the total volume regulation, leading to an immediate contraction of real estate lending. Loan reluctance and loan stripping became rampant. Companies whose funding dried up went bankrupt one after another. Stock prices plummeted daily, and individual investors suffered immense losses. The land myth everyone believed in crumbled with a resounding crash. Banks were left with colossal non-performing loans, and a long era of economic stagnation, known as the Lost Decade, began. Its effects continue to plague Japan even to this day. So, what can we learn from the collapse of Japan's bubble economy? The structure where success breeds the seeds of failure tends to repeat itself even in modern times. Monetary easing and low interest rates are effective for temporary economic uplift, but their excessive continuation leads to soaring asset prices and eventually destroys the market. And the runaway force of collective psychology can lead even the most intelligent individuals to make erroneous judgments. By learning from history, we can build a better future. Why did success become the seed of failure? It was the overconfidence born from distorted monetary policy and the illusion of absolute certainty. Who overlooked what? The government, the Bank of Japan, financial institutions, and the general public. Everyone was caught up in short-term gains, misjudging the fundamental reality. And the lesson for today is that economies always have cycles, and behind excessive euphoria, risks invariably lurk. The quality of decision-making differs between those who understand this failure and those who do not. History is constantly speaking to us. If you found this video helpful, please subscribe and give it a like. We present a new history of failure every day.
この失敗は歴史のほんの1ページ。世界にはまだ語られていない失敗が数多くあります。失敗の歴史をチャンネル登録して次の物語もぜひご覧ください。